Today is May 6, 2026. If you have been letting your investment plan run on autopilot, it is time to wake up and, check the dashboard. The economic landscape has shifted in a meaningful way. The Federal Reserve, after a series of rate cuts in 2025, has firmly pressed the pause button. At its recent April meeting, the Fed decided to hold its key interest rate steady, keeping it in a range between 3.5% and 3.75%. This wasn't a surprise to market watchers, but it confirms a new reality for investors. The easy money policies that many of us grew accustomed to are on hold, and the reasons why are important for every investor to understand. The primary culprit behind the Fed's decision is stubborn inflation. The central bank has a target of keeping inflation around 2%. However, the latest numbers show we are not there yet. In March, the Consumer Price Index, a key measure of inflation, jumped to 3.3% for the year. This marks its highest level in nearly 2 years. This isn't just an abstract number, it is the rising cost you feel for everyday goods and services. A significant driver of this recent inflationary pressure has been the surge in global energy prices, partly fueled by the geopolitical tensions stemming from the Iran war. This new environment has forced a dramatic shift in market expectations. At the beginning of 2026, most investors and analysts were betting on a continuation of the rate-cutting cycle that started in late 2025. The consensus was that we would see at least 2 more cuts this year. Now that thinking has been completely upended. The market is currently pricing in 0 rate cuts for the remainder of 2026. Some forecasters, like those at JP Morgan, even suggest that the Fed might need to hike rates again in 2027 if inflation remains elevated. This means the higher interest rate environment is likely here to stay for longer than many anticipated. For the average investor, this change in the interest rate outlook is a critical signal. The strategies that worked brilliantly in a world of falling rates might not be the best approach for the current economic climate. They affect the value of stocks, the performance of bonds, and the attractiveness of simply holding cash. Ignoring this fundamental shift is like driving with an old map. It is time to update our understanding and review our investment plans to ensure they are built for the road ahead, not the one we have left behind. Many investors see an S&P 500 index fund as a simple, diversified way to own a piece of the American economy. For years, this has been a fantastic strategy. You buy one fund and you get exposure to 500 companies, the largest and most successful in the United States. However, the nature of this index has changed dramatically in recent years. What was once a broadly diversified basket of stocks has become increasingly concentrated at the top. This creates a hidden risk that many autopilot investors are not aware of, a risk that is magnified in the current high-rate environment. The numbers are quite startling. As of 2026, the top 10 largest companies in the S&P 500 now make up over 40% of the index's market value. This incredible concentration is largely thanks to the phenomenal performance of a handful of mega-cap technology AI-related companies. While their growth has propelled the index to new all-time highs and padded the returns of index fund investors, it also means that your portfolio's performance is now heavily dependent on the fortunes of just a few giant corporations. If one of these behemoths stumbles, while large-cap stocks face concentration risk, small-cap stocks are dealing with a different kind of pressure in this 2026 economy. On the surface, the story for smaller companies looks promising. For the first time in years, analysts are forecasting that earnings of small-cap companies will grow faster than those of their large-cap counterparts. This potential for higher growth often attracts investors looking for the next big thing. However, investing in a small-cap index fund right now is a bit like watching a high-wire act. The potential reward is high, but so is the risk of a fall, especially when the winds of high interest rates are blowing. The main vulnerability for small companies is their relationship with debt. Unlike giant corporations that can issue long-term bonds at fixed rates or sit on massive piles of cash, smaller businesses often rely more heavily on bank loans and lines of credit to fund their operations and growth. Crucially, much of this debt is often at a floating interest rate or a variable interest rate. This means that when the Federal Reserve keeps rates high, the borrowing costs for these small companies go up directly and immediately. This can eat into their profits and make it harder for them to invest and expand. During past periods of rising or persistently high interest rates, small-cap stocks have often underperformed their larger peers for this very reason. For the better part of a decade, bonds and cash were seen as boring, low-return assets. Investors often grumbled about the paltry yields they offered. However, the shift to a higher interest rate world in 2026 has completely changed this narrative. For the first time in a long while, fixed income investments are looking attractive again. Simple cash is looking attractive again. The stabilization of interest rates, even at this higher level, has created a new dawn for these traditionally conservative asset classes, offering investors a valuable combination of income stability. Let's start with bond index funds. The rapid rise in interest rates in the years prior to 2025 was painful for bond investors, because as rates go up, the prices of existing bonds go down. Now that rates have stabilized in the 3.5 to 3.75% range, the outlook is much brighter. High-quality bonds are now offering respectable yields. For instance, investment-grade corporate bonds are yielding in the 5 to 6% range. U.S. Treasuries are paying 4 to 5%. This means your bond index fund can now generate a meaningful stream of income. Many U.S. investors suffer from a severe case of home country bias. We tend to invest heavily in what we know best, overwhelming allocation to U.S. stocks. The U.S. market has been the place to be for the past decade, but 2026's economic environment gives reason to look beyond our borders. U.S. stocks face high valuations and unique risks of concentration, so diversifying into international index funds is now crucial for a resilient long-term strategy. One straightforward argument: valuation. U.S. large-cap growth names dominating the S&P 500 are expensive versus many foreign counterparts. Lower valuations in Europe, lower valuations in Asia, lower valuations in select emerging markets. These markets let you buy similar growth at a lower price. That doesn't guarantee better returns, but it provides a better margin of safety and different growth sources. Beyond valuation, international exposure provides true diversification. Other countries' economies and market cycles do not move in lockstep with the U.S. The new rate environment of 2026 is not a reason to panic. It is a reason to plan. The set-it-and-forget-it approach to index fund investing needs a thoughtful review. You do not need to become a day trader or an expert market timer. Instead, you can take a few simple, deliberate steps to adjust your strategy to the current reality of higher inflation and stable but elevated interest rates. These actions can help you reduce risk, improve diversification, position your portfolio to be more resilient in the years ahead. Second, reevaluate the role of bonds and cash in your portfolio. For years, these assets offered very little return. That is no longer the case. With yields on high-quality bonds and cash alternatives now at attractive levels, it is time to consider them as a core part of your strategy. Adding a short-term bond index fund can provide a steady stream of income and act as a shock absorber. Adding an intermediate-term bond index fund can also provide income and cushioning. Holding a portion of your portfolio in a high-yield money market fund or short-term treasuries gives you liquidity and a decent return, providing dry powder to deploy when investment opportunities arise. Third, commit to a rebalancing schedule. This is perhaps the most powerful and underrated tool an investor has. Rebalancing is the simple act of periodically selling some of your assets that have performed well and buying more of the assets that have underperformed. This forces you to sell high and buy low, the exact opposite of what our emotions tell us to do. In the current environment, this might mean trimming some of your highly appreciated U.S. large-cap fund and using the proceeds to buy more of your international funds or bond funds to bring your portfolio back to its target allocation. This disciplined, non-emotional process is the key to managing risk and staying on track toward your long-term financial goals.